Okay. So here is the question that we are given. Because you can start with question number 1. The question reads, who is a financial manager? Okay. Who is a financial manager? The question is also a reference of the roles of a financial manager. Sometimes you can find it asking you, what are some of the roles of a financial manager? So a financial manager, the definition for a financial manager can be extracted from the roles that are performed by the financial manager. So what are some of the key roles that the financial manager performs? What did we say? What are some of the roles? Do you remember any? Well, it's been a long time.
This is to manage the finances that comes in and out.
Okay, I like the summary. So to manage the finances that come into the business and out of the business. Okay.
Yes.
Okay, thank you very much for that one. So just as said, the roles of a financial manager is to make the decisions, the 3 main decisions that hinge around the management of the finance of the business. That is to say, they make what are known as the financing decisions. Okay, that is to make the financing decisions. So they think about how to raise the funds that they are going to use to finance the different projects that the business engages itself in. So you find that the business usually has got a lot of things that need funds. So they make a decision that pertain to where to find the money, where to find the funds to finance the project. Is that okay?
Yes, sir.
Yes. Any question?
No.
That there is no question. Then they also make investment decisions. Okay. That is, they decide where exactly to invest the money. Okay.
Yes.
They decide where exactly to invest the money. So you find that there could be so many investment projects or options that they have, but they have to decide where exactly to invest the money. So that is called the investment decision. So they decide which option, of course, guided by some of the principles that we talked about. Okay, they look at the return, they look at the present value using all those techniques. Then they also make what are known as investment dividend decisions, right? The dividend. Now, when it comes to the dividend decisions, they decide how much of the profit should be declared as what? As dividend, or how much of the profit should be kept in the business as the retained earning. So they make that decision. They decide how much should be kept within the business and how much of it should be declared as dividend so that the shareholders can share. So that is the main role. Those are the main roles of the financial manager. So basically, if you know those roles, and by talking about those roles, then it means that you have summarized the key roles of a manager by talking about these key financing decisions that the managers make: the financing, investment, and dividend decisions. Any question?
So far, no.
Okay. The next question is on the market efficiency, and very, very important, question B. Okay. State and explain the 3 forms of market efficiency under the efficient market hypothesis theory. Okay, it might sound new, but I'll make it clear so that you understand what it is. So what happens is that we have got what we call the efficient market. So the efficient market hypothesis, an efficient market is just the one in which, number one, the price of securities, that is to say, maybe the bonds, the treasury bills, among others, bought and sold, reflect all the relevant information which is available to the buyers and sellers. The efficient market is the one where no individuals dominate the market. And the efficient market is the one where the transaction costs of buying and selling are low.
Okay.
I'm talking about the characteristics of the efficient market. So the efficient market, again, is a kind of a market. For example, if a company makes a profitable investment, right? Shareholders will get to know about it, and the market price of its shares will rise in anticipation of the future dividend increases. That is an efficient market. An efficient market is where if interest rates rise, shareholders will want a higher return from their investment, so the market prices will fall. That market is said to be efficient. Is that clear?
Yes, sir.
Now, there are 3 degrees of efficiency or market efficiency that are actually proposed or explained in the market efficiency hypothesis theory. And they include the following. Number 1, weak form. There is what we call the weak form. That's the first one, the first form. It is called the weak one, weak form. The weak form. What about the weak form? So the weak form hypothesis of market efficiency explains the changes in share price as a result of the new information which becomes available to investors. So it tries to explain the changes, okay? It explains the changes in share price. That is as a result of the new information which becomes available to investors. So I said it explains what? It explains changes. It explains changes in share price. It explains changes in share price as a result of new information which becomes available to investors. In share price, as a result of what? Of new information available that has been made available to what? To who? To investors, the investors. So that is the weak form, to the investors. So they explain, that is what it does, okay?
Yes, sir.
So the share price only changes when new information about a company and its profits become available. Yeah. So now, the research proves that the stock market displays weak form efficiency, okay, based on the following principles. When do you tell that this is weak form? These are the characteristics now of the weak form. Number 1, if the share price changes are random. Did you get it? Yes. The characteristics of the weak form. Characteristics of the weak form. Market efficiency. You find that number 1, the market is said to be weak form, efficient, if share price changes are random, okay? If the share price changes are what? Are random. You get it, eh? It is weak. The share prices changes should not be random, shouldn't be random. At least there should be some pattern. if there is no connection between past price movement and the new share price changes. Okay. So if at all there is no connection, if there is no connection between the past price, between the past price changes, between the past price movement, between the past price movement and the new share price changes. Okay, and the new share price changes. Okay, so if no connection, there is no connection between past price movement and the new share price changes. If there is no connection, we say that the market is exhibiting weak form efficiency. Is that clear?
Yes.
So if you want to do this statistically, you can say that there is no correlation between the successive changes in the price of the share. Okay, that is that the trends in price cannot be detected. There is no trend whatsoever. Yeah, that's about the weak form market efficiency. Any question?
No.
Okay. If the weak form is clear, we can talk about the second one, which is called the semi-strong form of market efficiency. The semi-strong form. Yeah. Under the semi-strong form, current share prices reflect both. Yeah, the share prices reflect both. Number one, all relevant information about past price movement and their implications. Okay, so it shows all relevant information, right? Information about the past, price movements, about the past price movements and the implications thereof and their implications. Is that clear?
Yes, sir.
In the semi-strong form, all knowledge which is available publicly. So what happens is that the share price is reflecting all information which is available publicly. So all info, okay, available to the public is shown. So it is actually reflected in the what? In the share prices. That is the weak form. So the information which is just known here is just that one which is available to the what? To the public. Is that clear?
Yes,
that
sir.
is the second form. The third one is called the strong. Yeah, the strong form, market efficiency. So with the strong form, market efficiency, share price says reflect all information available, number one. So the share prices reflect all information available, to who? Number one, from past price changes, okay? From past price changes, or information available from past price changes. Number two, from public knowledge and anticipation, or information available from public what? Public knowledge. So all that information which is available to the public is reflected in the share prices. And again, all the information which is available from insider knowledge available, okay, to specialists or the expertise, such as maybe investment managers. So even the private, in short, even the private information is what is reflected in the prices. So the weak form, there is no connection between the price movements. Then in the semi-strong, the information is there, available, just that one which is available to the public, but it does not show us what is available to the private, you know, the inside information is not shown in the same. But when you talk about the strong form, the private information that is available, okay, privately, is also reflected in the price changes. So there is that information which managers would not want everyone to know. You get what they publish is only that one which they want the public to know, but there is some information that they hide and keep to themselves. So in the efficient market, when the efficient is a strong form, when you have strong form efficiency market hypothesis, what happens is that when we say the market is very strong efficiently, we can say that even the private information is available to the people. Is that clear?
Yes, but on this one, from the past price, you said what?
From the past price changes.
Yes.
So yes, so I said that in a strong form, it means that the share prices reflect all the information available from past price changes.
Okay.
Yes. Then it also it reflects all technology and from inside. Okay.
Hello? Yes.
Yes, sir. So,
okay,
so that's what is there. Is there any question?
No.
All right. It's good to learn that you're now fine. Next question is, why is the discounted payback method preferred to the payback period approach? You know, remember I talked about investment appraisals. I don't know if it was in this class, should be in this class, isn't it? We talked about investment appraisals, present value, net IRR, yes. Internal rate of, yeah. So yes. I said there is also what we call the payback period, where you are checking how much time it takes for the investment to give back the initial investment. Yeah. So there is what we call the payback period. So under the payback period, you just check how much it takes, okay? How much time it takes. So for example, if you invested, let's say 15,000, that is your initial investment. Then in the first year, you get a 5, the other year you get a 7,000, of course. The other year you get, let's say 8,000, the other year you get 1,000. So this shows that you are able to get all your money after how many years? After 3 years, isn't it?
Yes, yes.
This one is called the payback period approach. But there is what we call the discounted payback period approach. The one that factors or the time value of money. So it discounts these. You remember, these flows are cash flow, they are in the future, right? These are future values. We've just projected them. So when you're dealing with the discounted payback period, you have to discount these. And I'm sure you're aware on how to discount these. You bring them back to the present by dividing, maybe, let's say 5,000 divided by 1 plus the rate of interest. You get it, right? Yes. You discount, bring them to the present. When you discount all of them, then you look for the payback period for the discounted cash flows. Then you are getting what is called the discounted payback method. Okay. So the discounted payback method, we can now say that it is preferred because it factors in the time value of money concept. It does that. So it discounts the money. Remember, one kwacha right now is not one kwacha 2 years from now. Money changes and usually keeps on losing value as time goes on.
Yes.
So the one that factors in that fact is called the discounted payback method. So that is the reason as to why it is preferred. Any question?
So far, so good.
What did you say is the difference between the net present value and the internal rate of return? An idea, the net present value NPV and the internal rate of return, or it has been long time?
I can lie on this one, I forgot.
The time has been long. Okay, it is well.
Yeah.
So under the net present value, actually, you discount. What happens? You get the difference of how much you have invested. Okay, you remove what you have invested from the present values. Okay, of what of the cash flows, the future cash flows. That difference you get is called the net present value. So that is the future cash flows, you have them, then you discount them, you bring them to the present, then you sum them up and you remove the investment, the initial investment, how much you invested. What you get is the net present value. Okay. But when you talk about the internal rate of return, you're looking for the rate of return, okay, that gives you at least the return that is equal to the investment. I'll repeat. There is the rate of return that can give you exactly the same value that you invested. That is the lowest you can get. So you're looking for that. So usually what happens, you can calculate for IRR just as I showed you last time. The IRR, you find that, let's say, for example, is 17%. Then the other one, you find that the net present value is this one, 17%. Then the target rate, right? The interest rate that is the cost of investment, you find it maybe at 12%. The cost of investment, this is the rate that is equivalent to the initial amount that you have invested in the business, right? So this one is the return. So if this return is higher, we say that you do what? You accept the project, because it means that the project is giving you higher return than what you invested, isn't it? If you get the IRR that is equal to this rate, 12, it means that you're getting exactly what you invested in.
What you invested, yes.
But if you get the IRR that is less than this, the project is worse, because it means you get less than what you did invest. Yes. So just think around that. You already know these things. What are some of the factors which determine the firm's capital structure? We looked at the firm capital structure is made up of two main components. We have the equity part, right? The equity part where you have the shares, and you also have got the debt part. So the equity part, this is where you issue stocks. People come to buy the stocks, they give you money. And then on the debt, this is when the company decides to go and get a debt from the people. For example, by issuing the corporate bonds, you can issue the corporate bonds. Then people buy those bonds, and by so doing, it means you've gotten a debt. So there are some of the factors that we look at when you are doing this. Usually, the factors would include, number one, the cost of debt. The cost of debt, okay? Cost of debt. Yeah, debt is just more like you get a loan. As a business, you get a loan from the public. It's not when the business wants to borrow from the public, they just issue maybe bonds, ventures, then people take their money. They don't follow you. The big guys, when they are borrowing, they call you and borrow from you. you're seated, you go, right? That is what happens. So the business is borrowing. When the business issues out those corporate bonds, just know that they don't have money. They are asking for money. They want to get a loan. But you know, they will make it so sweet that they tell you that no, when you give us your money, actually we are helping you, we'll give you back with the interest. Just know that they don't have money, they want money. They want to do something. Yes. So unlike you, when you want you follow the what's this, the banks to get the loans, whatever. But them, when they want, they are seated there, they just introduce a policy, then you follow them. Okay. Anyway, that's about that. So you look at the cost, right? Mainly you look at the cost, also the opportunity cost, cost of debt. Then you also look at the opportunity cost of what? Of equity, right? For you to buy shares, there is that opportunity cost. You can decide why you should buy the share. You can either decide to use the money you buy shares or get that money and invest in something else different, right? So you find that for you to invest in this company, which is risk, there is that cost that you incur, right? There is that sacrifice that you make. Remember last time I did comment, I said that what happens usually is the government usually gives out maybe treasury bills, you know. When you invest your money in the government, the risk is said to be zero. You don't have, they are risk free because those securities from the government cannot default on any of the securities denominated in the local currency. They don't default. So you decide now, should I invest in the government? But problem in the government, you find that the rate of return is low. Okay.
Yeah.
So let's say the government is giving you, when you invest that same money at 8%, right? That is, you are assured of getting your money. Then there is this company now which says, okay, we'll give you at 10%, right? So you have to rationalize now. I think, should I invest in this risky company, which might not even give back the dividends or don't give back, which is most likely to default, or invest in the government where I'll get? Okay. So now there is that issue of you going to this company. That issue of going to this company, there is an opportunity cost. That is the next best alternative that you forego. And the next best alternative you forego is to invest in the government, isn't it? That is what you sacrifice. You sacrifice investing in the government. So that is the cost as well that you consider. So you look at the cost of debt and the opportunity cost of investing in equity. Is that clear?
Yes, sir.
Any question?
No.
You're okay.
Yes, sir.
All right. We continue. A financial manager is evaluating the possibility of investing in one of the two assets. So the assets, costs, and the cash flows are given in the table below. Assume that the discount rate is 5%. The present value is given as that. So that's the initial. Once you find these are two assets that they have, the negatives simply mean that these are cash outflow. It shows you the direction of the money. The money is going outside the business, so that's why it's negative. So it means the first year, in year 0, you invest 30,000 for asset A, and again in year 1, you don't receive anything. Again, you invest another 15,000, making it 45,000. Is that clear?
Yes.
For project B or asset B, you invest 40,000. Then in the first year, you receive a 10,000, a 10,000, 10,000, 10,000 through up to the 5th year. Okay. Then this one in the 6th year, you receive 900. Second year, you receive 16,000. Right? Then the question now starts saying, can you define the net present value? We have already said the net present value in the previous slide, isn't it? It is the difference between the present, the present values of the cash flows okay, and the what? And the initial investment.
Yeah.
Yes. Or if you want, you can say the difference between cash inflows and the cash outflow. Sounding so technical, but that's it. So cash inflow simply means the money coming into the business. So
Yes.
the difference between the present values of the cash inflow, which means the present values of the money coming into the business, minus the what? The money that you invested, that is the cash outflow, right? Yes, that difference is called the net present value. Can you find the present value for can you find the present value of the costs investing in these assets? So you just find the present values for these two, right? Yes, find the present values for these two. Find the present value. There is 5%, that's a discounting rate. So to start with, you have to find first the discounting factor. So to find the discounting factor, you say 1 divided by 1 plus R to the power n. Okay. Yeah, you remember what I said last time. So you say 1 divided by 1.05, isn't it? To the power 0. That is in the present here. It is 0 power. Obviously, this will give us 1, right?
Yes.
As a discounting factor, this will be 1. Then in the first year, you raise this to the power 1. Divide 1 divided by 1.05 to the power 1. That gives us what? 0.952. Okay. Yes. 0.952. Again, in the third year, in the second year, you just raise this now to the power 2. You get it, eh? Yes. So you just raise this to the power 2. You say 1 divided by 1.05, raising it to the power 2. What do you get? I get 0.907.
Yeah.
Okay. And what do you get in the third year?
To be 1.05 the power 3.
What do you get?
We get 1.157.
Okay, you say 1 divided by, you open the bracket, like 1 divided by, open the bracket 1.05 to the power 3, like this. What do you get?
We get 0.86.
Yes, 0.864.
Yes.
0.864. What do you get in the fourth year?
The fourth year.
Find...
Get 0.8227.
0.8227. 227. Okay, to 3 decimal places, 0.827.
It will be 0.823.
0.823.
Yes.
Okay. Then fifth year. In the fifth year,
we have 0.783.
0.783. What about in the sixth year?
Sixth year. We have 0.746.
0.46. Okay.
Yeah, 746.
0.74. These are the
Six.
discounting factors, okay?
Yeah.
The discounting
Mhm.
factor. So to find
Okay.
the present values in for the first asset, present values, you can just start multiplying the discounting factor times
Mhm.
the value of the asset. So 1 times -30, you find the negative what? 30,000, right?
Yes.
Then what is 0.952 times the negative 15,000?
No. 2 times that is negative what? 15,000. We have negative 14 to 80.
Negative 14
to 8.
280. What about in the third one?
The third one 0.907 times 16,000. We have 14,404. Oh, 14,512.
512. What about the other year?
The other year we have that is 0.864
64.
times 8,000. I have 6,912.
6,912. The other
Yeah.
year?
The other year we have 0.828,
0.80.
80. No, not that one. No, I'm saying the number is 0.8228, eh?
Yeah, 0.828.
Okay, times that is 500. Well, 414.
414.
Yeah.
What about the other year?
700. We have 548.1.
548. What about the last one?
It's 0.746 times 900. I have 671.4.
671 point. Okay. Yeah. Let's do again for asset B. We are multiplying the same discount factor times now the cash flows from B. So 1
Okay.
times that one is negative that now 0.952 times 10,000.
52 times 10,000. We have 9,520.
Okay, the next one.
Next one, that's 0.907 times 10,000. We have 9,070.
9,070. What about the next one?
We have 0.864 times 10,000. We have 8,640.
8,600 and yes, the other one.
The other one is 0.828 times 10,000. 8,280.
8,280. What about the last one?
0.783 times 10,000. We have 7,838.
7,838.
30 and 30.
Oh,
Just
and
30.
30. Okay. Then the last one is 0, isn't it?
Yeah. Yes.
Yeah. So to find the net present value, what you do is that you add these which are positive and then subtract these which are negatives. Okay. Yes. You can do for asset A, and I try B so that we save time.
Okay.
9520. 9, 7, 40, one, that's 6, 9, 4 plus 10, 5, 2, 3, 4. Is it what? Negative 14, 80, minus 80,000. What do you find?
For the first one, I need to pick up everything or what?
You have to total up all these which are positive, then you subtract these which are negative.
Oh, okay. Just a minute. 14,504 plus. So I have to subtract from these two.
Just to say minus 14,280, again minus 30,000.
Okay. So I've got negative 19,233.
Okay, let me try again. 14,512 plus 6,912 plus
is this 6 or 8? It's 8.
6,912.
No, it's 8,912.
Oh, it was 8,912.
Yes.
Okay. So 14,512, right? Plus the 8,912 plus the 414 plus 548 plus 671 is equal to minus negative 14,280 minus 30,000. I find it negative 19,223. 223. Okay. Yes. So these are the net present values. I think you are getting acquainted on how to go about the net present values, isn't it?
Pardon?
The one that is, you are getting fine now on how to go about the net present values, yeah?
Yes.
Yeah, so asset B is 3,340.
Okay.
So the question is, which of the two assets have a shorter payback period? The obvious asset B, right? Asset A does not give us our money. You've seen?
Yeah.
Up to
Yeah.
60th year, we have not yet gotten our money. That's why it is still negative. We have not yet gotten our money. So
Yes.
asset B.
Yes.
Then which of the two assets have a shorter discounted payback period? What we are doing is the discounted payback period. What we are doing is a discounted payback period. This is still B, right?
Yes.
Yes. And based on the net present value, which asset must be preferred for investment? Is the asset B? You've seen that it was fun. All the answers were just for one question, one question, one question. So asset B because it gives us the positive net present what? Value.
But yeah.
Any question?
No. So on this one, I think you are right when you said 694.